If you sell on Depop, Poshmark, or Mercari, you've probably heard scary things about new tax rules targeting resellers. There's been a lot of confusion about the 1099K threshold and whether the IRS is coming after people who sell their old clothes. In this video, I'm clearing up exactly what changed, what didn't change, and whether you actually owe taxes on your reselling income in 2026. The answer might surprise you. Let's get into it. First, the big update. There was supposed to be a massive change to how reselling platforms report your income. The IRS originally planned to lower the 1099K reporting threshold all the way down to $600. That would have meant nearly every reseller received a tax form. But in July 2025, the One Big Beautiful Bill Act was signed into law and it reversed that plan entirely. The 1099K threshold is now back to $20,000 in gross payments and 200 or more transactions. Both conditions must be met. So unless you're doing serious volume, you probably won't receive a 1099K from Depop, Poshmark, or Mercari. But here's the thing that hasn't changed. You're still legally required to report taxable income to the IRS regardless of whether you get a 1099 form. The form is just paperwork. Your tax obligation exists either way. Now here's where it gets interesting. Whether you owe taxes depends entirely on one question. Are you selling personal items at a loss, or are you running a reselling business? Let's talk about the first scenario. If you're cleaning out your closet and selling used clothes, shoes, and accessories for less than what you originally paid, you do not owe taxes on that money. This is considered selling personal property at a loss, and the IRS does not tax losses on personal items. For example, you bought a jacket for $200 and sold it on Poshmark for $80. That's a $120 loss. No taxes owed. Even if you sold hundreds of personal items and the total added up to thousands of dollars, as long as every item sold for less than you paid, you owe nothing. However, there's one important caveat. You can't deduct those losses either. Losses on personal items are not tax deductible. Now let's talk about the second scenario. Running a reselling business. If you're buying items specifically to resell them at a profit, you're running a business. This includes thrifting, sourcing from wholesale, buying clearance items to flip, or purchasing inventory from liquidation pallets. In this case, you're self-employed and you owe taxes on your net profit. That means your sales revenue minus all your business expenses. How does the IRS tell the difference between cleaning out your closet and running a business? They look at several factors. Are you buying items with the intent to resell? Do you have regular and consistent selling activity? Are you trying to make a profit? Do you depend on this income? Have you set up business processes like tracking inventory? If the answer is yes to most of these, the IRS considers you a business. So let's break down taxes for reselling businesses. You're self-employed, which means you owe self-employment tax of 15.3% on your net profit. That's 12.4% for Social Security and 2.9% for Medicare. Plus federal income tax based on your bracket. Plus state income tax if applicable. Set aside 25 to 30% of your net profit for taxes. And if you expect to owe more than $1,000 for the year, make quarterly estimated payments. For 2026, those deadlines are April 15th, June 15th, September 15th, and January 15th of 2027. Now, here's where resellers can save serious money. Let's go through the deductions. The biggest deduction is your cost of goods sold, also known as inventory costs. Every item you buy to resell is deductible when that item sells. If you bought a pair of sneakers at a thrift store for $10 and sold them on Depop for $80, your taxable profit on that sale is $70, not $80. This is why keeping receipts for every purchase is absolutely critical. Second is platform fees. Poshmark takes a flat 20% commission on sales over $15. Depop charges a 10% selling fee. Mercari charges 10% plus payment processing. These fees are 100% deductible. On $20,000 in sales through Poshmark, that's $4,000 in fees you can write off. Third is shipping costs. Any shipping supplies you buy like polymailers, boxes, tape, tissue paper, and labels are fully deductible. If you pay for shipping out of your own pocket rather than passing it to the buyer, that cost is deductible too. Fourth is your sourcing expenses. Gas and mileage driving to thrift stores, estate sales, and garage sales is deductible at 72.5 cents per mile in 2026. If you drive 50 miles per week to source inventory, that's 2,600 miles per year, or a $1,885 deduction. Fifth is photography and listing supplies. Your phone or camera used for product photos, lighting equipment, a backdrop or photo setup, hangers, a steamer, and a mannequin are all deductible business expenses. Sixth is your home office. If you have a dedicated space for storing inventory, photographing items, and packing orders, you can claim the home office deduction. The simplified method is $5 per square foot up to 300 square feet, for a maximum of $2,500. Seventh is cleaning and repair supplies. Detergent, stain remover, fabric freshener, and any supplies used to prepare items for sale are deductible. If you pay for dry cleaning or alterations to increase an item's value, those costs count too. And don't forget, you can deduct half of your self-employment tax on your income tax return. Let me walk through a real example. Say you sold $25,000 worth of items on Depop and Poshmark in 2026. Your cost of goods sold, meaning what you paid for the inventory, was $8,000. Platform fees were $4,500. Shipping supplies cost $600. Sourcing mileage deduction was $1,885. Photography equipment and supplies were $300. Home office deduction was $1,000. And cleaning supplies were $200. That's $16,485 in total deductions. Your taxable profit is $8,115. Your self-employment tax is about $1,000. Without tracking deductions, you'd pay self-employment tax on $25,000, which is $3,125. That's a savings of over $20,500 just in self-employment tax. When it comes to filing, you'll use Schedule C to report your reselling income and expenses, Schedule SE for self-employment tax, and Form 1040 as your main return. Now what if you got a 1099-K but you only sold personal items at a loss? This does happen, especially if you cross the $20,000 threshold. Here's what you do. You still report the 1099-K amount on your tax return, but you offset it with the original cost of each item. If every item sold for less than you paid, your net profit is zero or negative, and you owe no tax. Keep your original purchase receipts or credit card statements as proof. Here's your action plan. First, decide if you're a casual seller or a business. If you're buying to resell, you're a business. Track every purchase with receipts or screenshots. Keep records of every sale, including the original cost. Save receipts for shipping supplies, cleaning products, and other expenses. Track your mileage when sourcing inventory. And if your reselling business is growing, consider working with a tax professional. Note, this information applies to US-based resellers. Tax laws vary by country, and some states may have different 1099-K thresholds. Consult local tax authorities for your specific situation. If this was helpful, subscribe for more gig economy tax tips. I've got guides for every major platform. Drop a comment if you have questions, and I'll see you in the next one.